Okay, hello everyone. Thanks for joining us as our search and matching seminar. Today, we're very happy to have Selman to present his work on regulating clearing in network. You can take over. Thank you.
Thank you very much for having me here. I will talk about central clearing counterparties and the Dodd-Frank Act. This work is joined with Pablo, who works at the Philadelphia Fed, so the usual disclaimer applies. And Guillermo and I would like to thank the NSF for their generous support. All right. So after the financial crisis of 2008, G20 leaders agreed to a bunch of reforms for the OTC derivatives market. And the explicit goal stated in the G20 report and after also in the Basel Accord is to improve transparency, reduce complexity, and mitigate systemic risk. And as part of it, it was stated that all standardized derivatives contracts should be cleared through central clearing counterparties, and those that are not cleared shall be subject to higher capital requirements. And these came into effect with the Dodd-Frank Act in the United States. Well, before anything, let me first describe what clearing is, what a central clearing counterparty is. Clearing is rooted in what we call novation, and novation is simply replacing one contract with two identical contracts and inserting a third counterparty in the middle. So suppose that A owes B $1. And if they novate this contract with a central clearing counterparty, now that original contract is torn and two identical contracts are signed, one between A and the CCP. Now A owes the CCP $1 and another contract between the CCP and B, and the CCP owes B $1. So A and B do not have exposures to each other anymore, and CCP becomes the counterparty to both of the original counterparties. Now, when you think of two banks, right, they can coordinate on how to deal with inefficient or excess exposures. And in fact, most banks have netting agreements between each other. They're called master netting agreements, and they do engage in bilateral netting to reduce the excess exposures. But when there are multiple banks involved, such coordination is not easy. Right? So let me give you an example. Suppose now we have three banks, A, B, C. A owes B $1, which is the red arrow. B owes C $1, which is the green arrow, and C owes A $1, and that's the blue arrow. Now, if all of these three contracts are novated, right, the blue contract gets replaced with these two, red gets replaced by these two, and the green gets replaced by these two. Now, all these three contracts, these exposures have been cleared, these contracts have been novated, and now, just by virtue of bilateral netting with the CCP, what's going to happen? These two exposures are going to cancel each other out. They will be bilateral netted between A and the CCP, and there will be no exposure left here. And same here and same here. So this new system, just by virtue of bilateral netting with the CCP, is going to have no exposures. So CCPs, through this mechanism, provide multilateral netting. Now, there are other forms in which CCP provides multilateral netting. If there are long chains of exposures, that can also be a place where CCP is effective. But these cycles are where the CCPs are the most effective, because when you think of, for example, a long chain or a tree of exposures, it's not clear what netting really, what multilateral netting would really do. Right? Equity is invariant to netting. So with this cycle, ultimately, I will describe what we call a coordination failure can arise. And by getting rid of these cycles, CCPs are going to provide beneficial multilateral netting. Okay, back to the banking reforms. As I said, the explicit goal of these reforms was to provide multilateral netting and to reduce complexity and provide greater transparency, move away from an opaque network of OTC exposures to a more transparent and multilaterally netted system. And the way in which this is to be achieved is actually by changing capital requirement risk weights, depending on whether the contract is novated or not, or the exposure is cleared or not. Prior to the regulation, I mean the Dodd-Frank Act, in the US, the average risk weight that applied to OTC derivatives was around 20%, and there was no difference between cleared or not cleared. Post-regulation, cleared and non-cleared contracts were subject to different risk weights, and the average risk weight that applied to OTC, what I mean by OTC here is all of these are OTC, some are clear, some are not, but when I say OTC, I will mean non-cleared. The non-cleared OTC contracts were subject to, exposures were subject to, on average, 50% risk weight, whereas the cleared exposures were subject to, on average, 3% risk weight. So that is a big gap. And if you think of cost of collateral, this can actually provide a significant incentive. Okay, so what happened since the reforms? This figure is from BIS, and the blue line here and the blue line here shows us a time series of the share of cleared exposures through central counterparties. And on the left-hand side, we have interest rate derivatives. On the right-hand side, we have credit default swaps. And as you can see, there is an increasing trend in both of them, right? And actually, when you look at the percentages, it is increasing significantly from very low to very high in both. And this is not just interest rate derivatives and credit default swaps. It also applies to foreign exchange derivatives. In this figure, this red here is the share of CCPs, and it is increasing from below 25% to above 50%. Sorry, this is USD trillions. So this is the percentage. This percentage is the percentage across all derivative exposures, rising from 2% to about 4% for a foreign exchange. And the interest rate derivatives, you can see it is increasing from 74 to roughly 78. So there is a clear trend, and exposures are being cleared more through central counterparties. But is this success, right? Can we just claim success by this? Okay, well, obviously, CCPs are becoming, in and of themselves, systemically important institutions, right? And there's a lot of work on the risk management of CCPs. And Vincent is here. Most of the literature so far has focused on the risk of CCP failures. Right? But we are actually taking a step back from that. There are indeed significant concerns about CCP failures indeed, but we want to understand what happens to the system overall and whether there are other changes relating to systemic risk.
Selman, can I ask a question?
Of course, yeah.
Are the contracts with the CCP collateralized or not necessarily?
Yes, they are collateralized, but I don't think it's fully collateralized.
And the OTC ones are collateralized or not necessarily?
OTC.
Unclear, sorry, unclear.
Yeah, OTC, I mean, I guess it's a matter of the agreement between the institutions, but OTC contracts, the non-cleared contracts in the data are actually heavily collateralized.
Okay.
That is something I will just say when we get to the data. Yeah.
Okay.
Can I jump on this? Sorry. So I think on the previous slide, you showed what was like OTC derivatives, right? So
yeah, these are the interest rate derivatives.
Yeah, exactly. And so some of them are cleared, if I understand correctly, because the CCPs are the counterparty. So I don't know, maybe for the audience, it's useful to explain that you can have like OTC traded derivatives or exchange traded derivatives.
I couldn't hear very clearly. Could you Repeat
sorry.
yeah.
Can you hear me? Can you hear me now?
Yeah, I turned up the volume. Once again, please.
Sorry. No, so what I mean is that what I see on the slide is OTC derivatives, right? And it seems that some of these OTC derivatives can be cleared, right? So I think it can be useful to explain the distinction between like OTC traded versus exchange traded and cleared versus non-cleared, right? You know, is there a perfect overlap, or, you know, can I trade a contract OTC and then clear it, or
Yes.
do I necessarily have to trade it in an exchange to clear it? I think it's kind of useful to explain that, maybe to people who don't know what it is.
Yes. So that's a good point. So I didn't actually talk about it. Both can happen. And this, I guess, includes both. We will be focusing, we will be modeling things as if the contracts are there and you decide to clear them or not. And these are OTC, these aren't really exchange traded. And I guess at this point, we don't want to go down to the exchange side of things. We'll be focusing mostly on clearing or not clearing an already existing OTC contract.
I thought it's interesting from the time series chart you have here, that is there's a structural break before and after 2020. Like since the reform, it has always been increasing till 20 and then sort of flat or decreased. And also for CDS as well. Are you going to say something about the time chart?
Yeah, I actually don't know about it. We don't see that here. There is a little bit of it, but there are similar little drops here for foreign exchange. Here for CDSs, we don't have that. I mean, some of these things might be related to COVID, but this is, I think, this is just like just very beginning of 2020, just before that. I don't have a good theory about it. I don't know why this drop happens. Thank you. I'll keep that in mind.
Can I ask, what's the cost of clearing over central counterparty? Why wouldn't everybody do it?
Yes, exactly. Great. So that's how we're going to start our journey after I get over these. Yes, very good question. My brief answer is transparency, but I'll get to that in a minute. Okay, so again, perhaps more clearing is to be celebrated, but can we take it as given that more clearing is always better? Like in particular, who clears and what do they clear? And what's the new topology of these exposures? And what does this new topology, along with these endogenous factors that led to it, imply above and beyond the CCP's failure risk? And we're going to take a look at the new topology of the network using confidential Y14 data. This is the data that the Federal Reserve uses for stress tests. And this is bank counterparty level credit exposure. Okay? And these are reported as the positive part after bilateral netting. And we are constructing time series for the largest 6 US banks. And their counterparties include pretty much everything: bank holding companies, other financial institutions, sovereigns, and CCPs. All right, so what we see in a nutshell is the core periphery exposures indeed shift to clearing. But somehow the exposures within the core do not. They remain OTC. And the core is actually quite intensive in collateral use. And just a very, very stylish version of the network we observe. Suppose there are these 3 core banks, 3 periphery banks. As we all know by now, core consists of a group of institutions that are densely connected to each other. Periphery has connections to the core, but typically periphery has few or no connections to each other. And that is, the general understanding. Well, perhaps the ideal consequence, and maybe the intended consequence, would be that, banks just go and clear these exposures, right? Then all of these cycles would be eliminated, right? By virtue of bilateral netting with the CCP, and that would provide the multilateral netting benefit that Jerome Powell was talking about. Well, what we observe is, again, in a very stylish structure, the exposures within the core do not move to clearing, whereas the exposures between the core and the periphery do. Right? So that kind of turns the network into something like this.
Can I make a comment?
Sure, yes. Please.
I think that, as you said, like you kind of assume contracts to be in place and then you vary sort of like the clearing stuff. But why do we need to take it as given? Could it be the case that once the pricing of this counterparty risk is changing with this incentives of how much, 3% versus 50%, 20% before, so why we don't go even to the trading network itself? Maybe like the whole network of counterparties is changing to start with, right? So we don't fix like exactly the same practice before and just change it who clears with whom. We just completely potentially rewire the whole network. You see what I'm saying?
Yes, absolutely, absolutely. So, well, the big six is big six. There is no problem with the core. And obviously, like, we cannot know whether there is some sort of like persistent, types of contracts that are always being signed on a regular basis. So it is not obvious to just say, well, this contract shifted. Well, maybe that contract is not there anymore, but this one that we think is shifted is just a new contract coming out of some new need, right? So there is nothing we can do about that, unfortunately. And regarding the counterparties, there is certainly quite a bit of that on the periphery side of things. On the core side of things, we fixed the big six, so we're good there. But on the periphery side of things, there is a little bit of change in the data actually. Like it's quite interesting. The data kind of has changed. The reporting requirements have changed. We are now trying to actually like identify who is who. But you're right. I think that sort of change in the structure and the need for these contracts and the counterparties is inevitable. And yeah,
I don't know if there's data, but like just what fraction of trades counterparties do between themselves versus with periphery before and after. Maybe that can just like a simple statistics can just sort of like explain like whether if it's pretty much the same, then like I don't worry about within core nothing changed, but core to periphery could change because periphery now could be trading more because they have CCP, for example.
Exactly. Yes, absolutely. I actually think that is potentially happening because when you look at the CCP risk weights, why wouldn't you, right? It's 3% on average. And let me just show you this then. Again, this after the data changes, now we are kind of generating the version of this, but this actually is going to look very similar. Here, as a fraction of the total exposures of the core, we are showing how much of it is to what institution, what set of institutions. So blue here is the CCPs, right? Yellow here is the core, the other big six. Now, as you can see, there's this other here, and there's this green non-financial corporations here, and there seems to be something happening here, and we are trying to sort this out. This is probably about reporting requirements and names and this and that. But I want to focus more on this yellow. If anything, core is becoming more exposed to itself, right? As you can see, like it is actually growing. And yes, the CCP is also growing, but perhaps not at the rate that the CCP's ratios in the total notional principles that we have seen in BIS reports, not as much as that is growing, right? So perhaps this partly speaks to what Michael was saying. The core structure seems to be similar, and the exposures, well, maybe there are a lot more new exposures inside the core that are now moving to the CCP, right? That we don't know, but ultimately, at least as a fraction of their total exposures, core's non-cleared exposures to itself seems to be stable or even maybe increasing.
Can I ask a clarified question? So is this a net exposure or gross exposure? Because I saw usually in the data, CCP doing lots of intermediation. So he usually have not much net exposure, but lots of gross exposure. Right?
Yeah.
This is related. If that is with periphery is already got moved to CCP, do they have anything left if it's all about intermediary?
So this actually, so gross and net, there are two ways in which it can be gross and net. So the gross here, this gross refers to not net of collateral. So there's a version of this in the data which is called net, and that is net of collateral. Now, if we're talking about bilaterally netted versus not bilaterally netted, these are all after like master bilateral netting agreements have been applied, and this is not net of collateral. And a significant fraction of this yellow is actually collateralized. Yeah. Okay, so before I start talking more about our theories, I want to make a tiny remark here. Okay, so when you look at the way the Basel Accords and all these regulations were written, you might think that all the standardized derivatives have to be, right, are mandated to be cleared, right? But this kind of makes us think a little bit. Is all of this exotic? And what is even a standard derivative, right? And how can we mandate clearing of standard derivatives? If I take a contract and add a 1,000-page appendix to it, full of arcane contingencies, is that now an exotic contract? So it is very difficult for us to figure out like how much this is mandated and how much it is not. And perhaps the regulators were aware of this challenge, and that might be why they also introduced incentives, right? Maybe those incentives aren't just for exotics. Maybe those incentives are there to make sure, you know, well, if we cannot enforce this, at least we have the incentives, right? And in fact, Jerome Powell in his speech actually uses the word sufficiently standardized instead of standardized. So in our theory and in my talk, we are going to disregard mandated clearing, and we're going to focus on incentives. But let me note, actually, if we, I mean, I haven't said anything about the model, if we allow for some probability that, you know, it has to be mandated and some not, it only strengthens our result. But this way, like, we are shutting that conversation down, but it is not an issue for our theory. And the incentives we are focusing on is, I'm going back to the earlier question, the capital requirements relate to the cost of collateral. If you clear a contract, right? If you clear an exposure, CCP has much less risk weights, so that saves on the cost of collateral. On the other hand, as evidently said many times by the regulators, you know, clearing comes with additional transparency. Now, what kind of transparency? I will talk about that. But for a minute, believe me that transparency is going to be a concern for these banks, and to hide their weaknesses and to maintain their liquidity, and this is the typical opacity versus transparency debate, they prefer a more opaque network. And that's the trade-off.
Sorry, Selman, can you, sorry to interrupt.
Yeah.
Could you just, I was puzzled by this. It was a question I had about the paper. Can you explain again why this would strengthen your results? To me, if a mandate can bind, then that's effectively an infinite capital requirement, which will, I think, kill a lot of the results or a lot of the incentives you would find in your paper.
So do you mean the empirical findings or the theoretical findings?
So I accept that's an empirical fact that there are core-to-core exposures, but I'm saying if the mandate could bind, then you would essentially you wouldn't have the discussion, right? You wouldn't have the strategic ability to go with other core members.
Absolutely. Let's just suppose for a minute that like standard is well defined, There's no gaming around it. And it is actually like applied. And all the standard derivatives are like necessarily going through CCPs. Now, the core message out of this figure is yellow, actually. So that's what we are going to focus mostly on. So this is the essence of what we are learning from this. And it is indeed quite hard to believe all of this is exotic, but that can be checked additionally if that data is available. And that's a good remark. We will keep that in mind. But as long as there's some sort of endogeneity here, our results are going to go through, right? Because if these were standards, right, they would have to go through the CCP, they wouldn't be here.
Sure.
So if it's applied, all of these are exotic, then incentives apply. So this is coming from incentives, right? So that we know.
Okay, thank you.
And just I think a point of clarity when you're saying exotic, I think it's important to note what you're saying there is that they cannot be cleared or that they are not required, because there's 3 categories of ineligible to clear,
Yes.
eligible, and mandated.
Yes. So what I am thinking of is not required to clear, right? Now, if all of these are ineligible to clear, that's something else, right? But is ineligible actually determined by the regulator or the CCP? Now, that is a whole different story. For a minute, if we disregard ineligible, right? If it is like all eligible and some of it, has to be, some of it not, right? And if this is not going to the CCP, it means these are not required to be cleared, right? And according to the story, these are all chosen to be non-cleared. And the explanation for that is incentives, I suppose. Yeah. But yeah, ineligible is a different story. I'll need to think a bit more about that. Thank you.
Is there a difference in the composition? Like, let's say that TDS are mandated to be cleared CCP first and then interest rate plus. Is there like, if you break down this yellow area, do you see like shift kind of like indulgence maybe towards more interest rate derivative spread in between core, like is there a way to break it down?
Yeah. So actually we do, and most of these are interest rate derivatives. But yeah, we didn't look at the time series of how it changes. That's a good remark. Thank you.
Do you know who goes to the CCP? So what's the composite? I'm asking the opposite question of Michael. What's the composition? Not in terms of instrument of the blue area, because the banks seem to have their own purple share.
Yeah.
So who goes to the CCP?
So these are all the exposures of the big 6. And this is how much of their total exposures they clear with a CCP. And behind this, obviously, some of these are Bank of America, some of these are Citi. And actually, like as soon as we deal with the new formatting of the data, we're actually going to give the detailed network structure as well. But at this point, this is just sum across all of the big 6. How much of that exposure is cleared. And this purple is how much of that exposure is to banks, but they are not cleared, right? So this blue originally could be, if it is not exchange traded, right? It could be originally part of yellow, part of purple or whatever, but they have been novated. So now that counterparty is irrelevant anymore. The counterparty is the CCP. Okay. So the primary question is, given the observed reactions to regulation, is the system more stable? We want to understand this better. Well, first, we need to get a better grip on 3 puzzles, if you will. First of all, why CCPs have been there for 100 years? Why were they not used as extensively pre-reform? Second, well, why is the reform effective, but partly, right? And finally, it is effective, but not on the core exposures. Why? For that, we are going to use a model which has an endogenous exposure network, an endogenous clearing decision, endogenous contracts, endogenous information, and we're going to compare two regimes of capital requirements. And in a nutshell, our theory is as follows. As I said, transparency is not desired by these banks because they want to hide their weaknesses and they don't want to scare off liquidity. And they want to maintain their opacity. And the CCP leads to more transparency. On the other hand, obviously, capital requirements are more lenient for cleared contracts, and that saves on the cost of collateral. And there's a trade-off here for banks to solve. And regarding the first question, the CCPs were not used extensively pre-reform because why would you? There is no incentive to, right? The only thing that could potentially happen is more transparency. And why is the reform effective on certain segments of the market? Well, risk weights, right? If some banks are collateral constrained or they quote unquote value opacity less, right? And they will go for the reduced cost of collateral and they will choose clearing because of the risk weights. And what about core exposures? As I will try to argue after describing the model, when banks have higher collateral, they end up valuing opacity more. So core banks with their higher collateral, they are first more able to be capital adequate against the high OTC risk weights. And moreover, because they have more collateral, it has an impact on the size and type of contracts they sign, which ends up making them value opacity more. Okay. Now, after I describe the model with all of its pieces, I will be able to talk about this. But before that, I need to introduce a few concepts that relate to contagion and what happens on a given network of exposures. That part builds on the Eisenberg-Noy and Acemoğlu, Özdağlar-Tahpas-Salihi models. It's the standard balance sheet contagion. Think of a bank has some assets, A, which serves as the collateral. And as a change, we introduce an aggregate shock to it. So alpha A is the external assets. And E plus here is the exposure, the total exposure of this bank to other banks. Okay? These are interbank assets, hence exposures. On the liability side, this bank has L liabilities to external creditors or investors, and this has seniority over the interbank liabilities. Okay? This is the sum of the exposures of the other banks to our bank, which is E minus. Okay? One final piece, if this equity falls below zero, then there are fire sales, and as typical in this literature, there is a non-trivial recovery rate, lambda, which is less than 1. Okay? So it is clear how contagion works in this kind of a framework. Normally, a bank might be solvent under normal circumstances, but if the bank recovers less than the sum of interbank assets, may not be able to pay all of its interbank liabilities, and this way contagion can spread. And as is the case in all of these models, there is a system of payments that is consistent with proportional payments, and it is solved simultaneously. It's the standard Eisenberg-Noy. All right. Now,
Selman,
given all of that, yes.
How does collateral is reflected in this?
So this is what happens. Actually, this kind of backward induction. I am describing what happens after all of the contracts, matching, investment, collateral, and blah, blah, blah. So this A is going to include the collateral, which is some illiquid assets of the bank. And there will be other projects and investments as well. But in the model, as we get to this contagion stage,
So collateral is the general assets of the firm, is not contract specific.
Yeah. So like the general asset of the firm is distributed, and it is used, like parts of it are used as collateral for specific
Because
contracts.
the assets of the firm serve as collateral. It's not that each interbank loans is backed by its own collateral.
Yeah. There is collateral behind it, but there is a little bit of a detail that I need to describe further. So technically speaking, so in the equilibria that we will be looking at, either there will be like no default or everybody defaults and they all make zero payments to each other. So the collateral actually is not going to have any effect on the dynamics of contagion here. Because then when there is a crisis, just everything just burns. But like there is a non-zero recovery rate, and that gets used to pay some of the investors first, but there will be nothing left to pay pay for the interbank liabilities anyways. So the contagion is not going to be affected by how much collateral was being used in that contract.
And are these interbank exposures bilaterally netted, or the gross exposures?
Yes, absolutely. These are bilaterally netted. Yes.
And so if we switch to CCP, then these E's could be different.
Yes, absolutely. Yeah. So this is just typical, but like there can be the CCP exposures to the CCP and CCP's exposure to this bank as well. But like for a specific entity, there will never be a positive term here and here at the same time. Okay. So let me first describe one of the core concepts that we focus on. So, also in earlier papers, it has been highlighted that cycles are important when we study central clearing. Now let's just give an example of how that works in this Eisenberg-Noye framework. Let's just take 3 banks, A, B, C, and let's take a cycle of exposures between them. A owes B $2, B owes C $2, and C owes A $2. The external assets after the aggregate shock is 4. Right? This is just at that specific time after all has been done. Now we are just facing contagion, that point in the model. And external liabilities are 3. Okay, this is one system, and let's see what might happen on this system. And the recovery rate is less than 3/4. Scenario 1, take one bank, say A, and in this scenario, it does receive its interbank asset too. What happens then? Now, this bank does not need to and will not and should not liquidate the external asset. So it has 6 and it can pay 5. In that case, B also receives 2. So B has 6, can pay 5. And then C also receives 2, has 6, can pay 5, and nobody needs to default. Great. What about the second scenario? Let's just for a minute, remember, as I said, these are solved simultaneously. Suppose that A, for some reason, does not receive that 2, receives 0. Then what happens? Let's go back here. It needs to pay 5, but it has 4. It cannot pay 5 sales. That 4 goes down to 4 lambda. Okay, but 4 lambda is less than 3. And external investors have seniority, and that 4 lambda gets paid to the external creditors, and there is 0 left to pay B. Well, then the same thing happens for B. Given that B gets paid 0, it can only pay 0. And given that C gets paid 0, it can only pay 0. And now this has become a self-fulfilling situation. And this is what we call a coordination failure. Now, obviously, like 2 banks can come together and resolve this issue, maybe 3 as well, right? But if we are talking about very large systems with complex exposures, with different maturities and so on, it's not so easy to get rid of these coordination failures. And in the second equilibrium, all banks default. And this is our notion of a coordination failure. And this is exactly on the same system. Banks pay nothing and default because they get paid nothing. Right? And it's completely consistent. Okay, formally, a coordination failure is the bad equilibrium when this good and bad equilibria coexist. Okay? If the unique equilibrium is everybody defaults, that's not a coordination failure. That's a material financial crisis. It's insolvency everywhere. Right? If alpha is very small, collateral is extremely like there is no value to the collateral. Well, we don't call that a coordination failure because that is not a function of the network structure. That has nothing to do with what happens to the topology. Right? That's a material default. And if alpha is sufficiently large, what I just told you is never going to happen. Okay? Because unlike some other models, we are not allowing banks to default just because they default. Okay? Remember, if this 4 could all of a sudden out of nothing could turn into 4 lambda, yeah, there could be contagion again. No, there's default only when what we define as default happens if these interbank liabilities are not received. Not because self-fulfilling the bank defaults because it defaults. Okay? All right. If there is no cycle, and this is a general result, what I said, what I defined here as the coordination failure can never happen. Right? All banks continue and all banks default equilibria cannot coexist if there is no cycle, and we can show that. And in this example, as you can see, right, if all exposures, if all of these 2s were cleared with a central counterparty, obviously there will be no exposure network left, and there would be no bad equilibrium. And the unique outcome would be no default. So central clearing at this scale resolves this coordination failure. But then again, what gets cleared, right? Is everything going to get cleared or not, right? We don't know. Now, we are going to use this framework to mainly focus on the probability of a coordination failure. And that probability is going to be found jointly by the distribution of the aggregate shock and the system and its cycles. And the system is influenced by the regulation. And we're going to look at how regulation alters the probability of a coordination failure that I just described. So our primary question is, are the incentives in the regulation actually effective in weakening or eliminating these cycles? Well, just a spoiler, in a core periphery structure, pretty much by default, pretty much by definition, the cycles are in the core because periphery is by definition doesn't have, intense set of links with each other. Periphery part is already very sparse. So by definition, cycles involve the core. But if the core doesn't react, you're not doing anything to the cycle, right? And then you're not addressing the coordination failure. Okay, the second core concept is decoupling. And this is, to be honest, way more subtle than the coordination failures. Think of a literal core periphery network this time, again, over an example. 3 core banks ABC and 3 periphery banks A prime, B prime, C prime. And in this example, we are going to take the core to be exactly identical as cyclic set of exposures to, there will be no periphery exposures, and the gross exposures before bilateral netting, okay? The exposures that come out of the contracts, right? Because the contracts can entitle banks to payments in each direction, right? But then it will get bilateral netted, of course. The exposures, gross exposures, coming out of the contracts between the core and periphery is every core bank, actually, let me just show you the figure here. That's a lot easier. This core bank A is going to owe its periphery counterparty 2, and that periphery counterparty is going to owe its core counterparty 1. And the same for every pair. Okay? This is the network we are looking at. One more important piece, all banks have external liabilities 3, core has collateral 4, periphery has collateral 2. And only for simplicity, strictly speaking, only for simplicity, lambda is 0. Not in the model here in this example. Okay, so this is the network we are facing. 4 alpha is to be received by core banks, 3 is to be paid to external creditors, 2 to periphery, 2 to core, 2 from core, 1 from periphery. Okay. Suppose in this system, there is no clearing at all. Okay. What's going to happen? After bilateral netting, obviously that exposure between core periphery pairs is going to go down to 1. And let's look at the region of alpha where there is a problem with the system. A core bank's equity is 4 alpha from the external investment, external asset. 3 must be paid to external creditor. 0 will be received from the periphery, but 1, the purple 1, must be paid to the periphery. And as for the core, 2 will be received from one core member and 2 will be paid to the other core member. Okay. This adds up to 4 alpha minus 4. And this adds up to 2 alpha minus 2. If alpha is larger than 1, there is not necessarily any problem here. If alpha is less than 1, there is material default. Okay. That is not a region we are interested in. Okay? That's the exogenous part. Let's look at the region at which there could be that coordination failure I told you about. Although it is not necessary, all banks can default. Just to check for consistency, suppose that these banks do not receive their interbank assets. So this 2 turns into 0. That is not received for a core bank. And this 2 turns into 0. Oops, where am I going? Sorry. This 1 turns into 0, right? And this 2 turns into 0. Just to check for consistency, suppose no banks receive any of their interbank assets. Then for which alpha is it consistent that they can actually pay nothing to other banks? Right? This adds up to 4 alpha minus 6. And this adds up to 2 alpha minus 3. So if alpha is less than 1.5, right? When banks receive none of their interbank assets, they can pay nothing. Okay. And when alpha is between these two numbers, we say there's a coordination failure. If you're confused, let me clarify one more thing, but I'll try to be a bit fast. Now, this is not the only condition for a coordination failure. This says if the bank does not receive that 2, it defaults. But when it defaults, what happens? This 4 alpha becomes 0. That becomes lambda for alpha. And when that's 0, it can pay nothing, right? Obviously, in the actual model, there is a lambda here, and the coordination failure is not found as simply as this. And same here. This seems to be just a default condition, but when there is default, this 2 alpha becomes 0. So if there is 0 asset, 0 can be paid and 0 payment. So when alpha is less than 1.5, receive nothing, pay nothing is an equilibrium. And as I said, if alpha is less than 1, it is material default, it's not a coordination failure. If alpha is larger than 1.5, these banks can make payments even if they receive nothing. But then you can iterate on that. If that's the minimal payment they will receive anyways, then they can make more payments. Well, if that's the minimum payments they receive, iterate on that, they can make more payments and so on and so forth. And actually, there are no defaults. Okay? So this is an if and only if condition for a coordination failure. Now, let's look at what happens to this region when these banks actually clear, but asymmetrically. Suppose P clears its exposures to C. Remember what the original exposures were. There is an arrow 1 here. Now, periphery is going to, this is an exposure for the periphery, and suppose peripheries clear these exposures 1. Then the system turns into this. Normally, periphery would need to pay the core. Now periphery needs to pay the CCP. CCP needs to pay the core. Okay, and we're going to find the coordination failure region in this new system when the periphery clears, but the core does not. Okay, this is under normal circumstances, and as netting, as equity is invariant to netting, this being positive means exactly alpha larger than 1. Netting doesn't change that. Okay? If alpha is larger than 1, these are positive. If alpha is less than 1, these are not. What about the upper region for that alpha? Now, suppose that this 1 is not received, and this 2 is not received, and this 0 is not received. We're going to find the alphas for which receive nothing, pay nothing is an equilibrium. This turns into alpha less than 7/4. This turns into alpha less than 2. The smaller one is 7/4. So if alpha is between 1 and 7/4, there is a coordination failure. Actually, if and only if, as before. As you can see, when periphery clears and core does not, the region of alpha, regardless of its probability distribution, the region of alphas for which there is a coordination failure has grown with respect to set inclusion. Okay? So that's an unambiguous harm. And the reason is there would normally be bilateral netting between the core and the periphery. But because of the asymmetric reaction, for the sake of multilateral netting, when periphery and core react asymmetrically, we got rid of the bilateral netting. Okay, now we have multilateral netting, but what does that do? Multilateral netting is beneficial for systemic risk only when it clears cycles. But cycles are in the core, and it seems in the data the core doesn't react. So the asymmetric reaction of the core and the periphery increases systemic risk in the sense that we have defined it. And actually, intensive margins make it worse. Why? Because this 1 after regulation is not going to stay as 1. This is clear. There are loser risk weights here, and this 1 perhaps is going to become 1.5. And this is going to be even larger than 7/4. So intensive margins and reduced CCP risk weights actually make this situation worse.
Just a reminder, maybe 7 minutes.
Okay. Now I'm going to be very quick about this part. Now, as you can notice, this is slide 32 out of 38. You may be thinking, what is happening? We haven't started the model yet, and that is an intentional design. Now, in the model, we ran out of Greek and Latin letters. It's a very complicated model. When you really want to do endogenous information, exposures, regulation, like clearing decision and whatever, turns out you need to use even iota. So it's not possible to, like in reasonable amount of time, go over the whole model. So I'll just give you the key parts of it and talk about very briefly the transparency part. Now, there are finitely many banks, and each bank houses a mass of bankers, and this is so important. There is no way on earth, I think, I don't want to speak for my co-authors, maybe they could, but I'll just say that it's very difficult to solve these models, as you all know, right? Like Eisenberg-Noy, I mean, those models are very difficult, as you all know. Like the only way we were able to deal with this beast is actually making use of the continuum. The banks are going to borrow from some creditors and make investments, and those will serve as the collateral for the bankers. Bankers are going to take those projects as collateral and will be matched with other investors, borrow from those investors and make additional investments, okay? And then they will be matched with bankers from other banks, and they will want to insure each other against the investment returns. Now, I have to make a remark here, right? The bankers, ultimately, in the end, there's a continuum of them, are going to be paid proportionally to their contribution to their bank. The bank is going to end up with some equity, and whatever the banker's contribution was, the banker is going to receive some contribution proportional to it. So the banker actually does care about the returns from the investment it manages. Then the pair can choose to clear or not. Here's a critical thing. If they choose to clear through a CCP versus not, the investor that funded this banker, the bank actually, but the banker moves on behalf of the bank, the information about the quality of the investment that this banker used the money for is going to be revealed to the investor with higher probability. So if a banker invested the money in a bad investment, doesn't want that information to get out. So he has incentives to choose OTC. And if the investors obtain information that the investment was bad, they may withdraw their funding. After all of this, bank consolidate their positions, and that is a lot of integrals over all the bankers in the bank. And exit shock comes, and there's contagion and liquidation Heisenberg-Noye on that consolidated positions on the finite interbank network. But then every bank ends up with some equity on that finite network. Then that equity is going to distribute it to the bankers, proportional to what their contracts and investments and borrowing, their activities provided to the bank. Very briefly, I want to highlight this main trade-off that two bankers that are matched face. Bankers can be good or bad, and good bankers have better investment opportunities, which have higher probability of success. Now, when two bankers get matched and they sign an insurance contract, they can decide to clear this or not. What's going to happen? If they clear, if they intend to clear the contract, they can design the contract that is capital adequate for lower risk weights. So that means a less constrained contract, which means higher insurance gain. But if it goes through the CCP, there is more transparency and it can be figured out and they can lose liquidity. And for the OTC, it's the reverse. Okay? If they design the contract in a way that is going to be OTC capital compliant, capital adequate, there's going to be lower insurance gain because it is more constrained, but there's going to be a higher probability of keeping liquidity. And they choose the optimal one. Ultimately, this is the final and key message. If we have a bank with higher collateral and its bankers also have higher collateral, they're going to be less constrained. And they're going to have larger contracts, which have larger insurance gains because it's just less constrained. And they can satisfy capital requirements more easily. Because these are less constrained, these contracts have higher value for them compared to the option, like the possibility that they may lose the liquidity and the contract by being figured out. And since they have more collateral, they also have easier time maintaining their opacity by staying OTC. So higher collateral bankers / banks are going to clear less. And this asymmetric reaction is going to do what I described you in the earlier part. There's going to be decoupling and the core doesn't react, and intensive margins make it even worse. And the suggestion is to induce clearing of cycles, we need more opaque clearing And for getting rid of decoupling, we need the CCP risk rates to be higher. And the continuum is very, very helpful. And we can solve everything in closed form because of the continuum. And this is the final remark I'll make, and I'll conclude. In the model, these bankers in the banks are infinitesimal. They have incentives because they get proportional payments from their bank, but they have no influence on the balance sheet of their banks. So they are basically network takers. Just like price-taking agents in general equilibrium models, our agents are network and contagion takers. So we can do network formation, and all the network and default probabilities, just like a market clearing condition, are going to be determined in equilibrium. So the contracting problem in a normal network formation model is a nightmare. But here, because of the continuum, it's a lot easier. All right? And I will conclude here. Thank you so much.
Thank you. We're now open for discussions, and there are some questions from the audience.
Oh, there are
sorry,
many.
that's already answered. Sorry, I said, okay, then we're good. Then we can, any question from the panelists, you can go ahead to unmute yourself.
I have a quick question. So on the cost of collateral and the incentives to clear the contract, it seems to me that you view collateral cost as a fixed cost in the sense that if I'm born with a lot of collateral, or if I'm large, it's going to be easier for me to satisfy the collateral requirements, right? But if I see, you know, like the collateral cost as something a bit less fixed, maybe these different incentives will change, will not be the same, right? Do you see what I mean?
Yeah. So the cost of collateral, actually, it's important. It's a unit cost. So out of that potential collateral that the bank gives to the banker to use, right? If the banker posts some amount, right? Some opportunity cost was incurred on that amount. So it's per unit, it's not actually fixed. So then you might be confused, like which way it's gonna go. And certain results are going to depend on the regions of that unit cost. But what I just told you here actually goes through because there's also the insurance gain part. So it is insurance gain minus cost of collateral. What the unit cost of collateral can do is, when it comes to satisfying regulation between the two counterparties, whose collateral is going to be binding, the insurance buyer or the insurance seller. The unit cost of collateral can determine that. Sometimes they may want to have a large contract, and sometimes they may want to reduce the contract size to let go of insurance gains to reduce the cost of collateral. So it can have an effect on the contract size. But again, this statement is about higher collateral. So even if like the cost of collateral, unit cost of collateral is in that region, and so the banks actually may want to like have smaller contracts to save on the cost of collateral, it is still true that the bankers with the higher collateral are going to have larger contracts relative to bankers with lower collateral. And so higher collateral banks and bankers are going to clear less. And that's what's important.
Okay, thanks.
Mm-hmm.
So I'm going to ask my second question, sorry.
Yeah. So
I was wondering, like in your model, so you talk about opacity. So I can see that there's a private benefit for banks to remain opaque vis-a-vis their creditor. But is there any, social value of opacity, like some kind of Hirschleifer effect in your model? So I don't know if you're after like optimal design because the model looks complicated, but that would be an interesting thing to address.
Yes. Well, I want to give a short answer, and I also like if Guillermo has something to add to it. So I actually think that is a very important aspect. So I don't think we want to kind of like claim that transparency is the devil here, right? Like part of the transparency that is being talked about in the regulation isn't necessarily transparency regarding a few actors, but it's also transparency about the whole system and some aggregate statistics about the system, right? And I do think there is social value to transparency in that sense, at least, at least for the sake of investors, not maybe bankers. And actually, in the model, in the paper at the very end, we have a section where we look at mandated clearing, like everything must be cleared versus nothing is cleared. And there, this trade-off becomes a little bit more clear. In the incentive part, the transparency leads to, through incentives, no clearing, and there's just literally no benefit of transparency. But actually, transparency, even in this model, is helpful for the investors. And there is typically a trade-off, and even in that mandated regulate clearing version of our paper, there are regions where clearing can be a wealthier improvement. But I think even beyond transparency about specific like investments and banks and bankers, I think it is an absolutely important piece of future work to look into incomplete information about the actual network and what people can learn from CCP activities and CCP reports about the aggregate structure of the network, maybe not necessarily individual banks. Guillermo, anything to add?
Yeah, no, thank you, Vincent. That's a good question. There are other models that analyze the welfare implications of opacity, etc. We're not delving into that here. I suspect that here transparency is better from a welfare perspective, because you don't have the standard effects of, well, you mentioned here Schleifer, or there is no gain from liquidity from here, or there is no effect of transparency on destroying collateral. So we don't have all those sorts of effects. Still, it's true that here the way it operates is that I may be sitting on a bad project, and I just want to create an insurance, and then if I deliver that information to you, you may withdraw the funds to put it in a better alternative. So in that sense, there is no welfare cost for that. And there is no welfare gain either. It's more a redistributive effect. But we could introduce those, and that would be very interesting to think through. We didn't want to enter into the discussion here because that we want to focus on the effect on systemic risk. Otherwise, it becomes like a nightmare. But that's an important question, of course. Thank you.
Hi, Selman. So what determines whether a bank is core versus peripheral in the model? Is that exogenous or endogenous?
It's exogenous. It's so here's the thing. So exogenous, and like if we go into like technical details, there are these matching rates between bankers of specific banks, and banks also have some certain level of collateral. Core is defined as defined through both those matching rates and high collateral, but it's exogenous. Yes, this is not a story of emergence of core periphery.
So the bankers of core banks have a higher matching rate with other bankers. Is that the assumption?
No, they have positive matching rates with each other and the periphery, but the periphery has very small or zero matching rates with each other. So there's basically the structure is assumed to be core periphery, but on top of that, we put more collateral to the core.
Selman,
yes.
I don't know if you know if there is any difference in the maturity of the contracts that are cleared and the ones that are not cleared.
I mean, so I think that's a very important part. So in this kind of a static model, there's nothing we can do about it, but I think my guess would be exactly. I mean, I don't know in the data if we see we just see exposures, right? We don't see the exact maturity. They are reported with respect to market value, and we don't know the underlying contract's maturity. And that, I think, can be a very important factor when it comes to like clearing or not.
The way I was going to connect this question to the model is if there is, so if and I understand the model is complicated, but if say short-term contracts, overnight contracts are cleared between, are done between core dealers, then I could think that the cost of that the collateral is essentially reused. So the cost of collateral could potentially be much smaller than what it appears to be. While long-term contracts can be clear CCP on the can be just cleared, and somehow the difference in maturity could equalize marginal gains.
Yeah, that makes a lot of sense. That's a very, very good point. Yeah. Yes, I have nothing more to say than a great point. Yeah, it's possible. Yeah.
Selman, hi. Just a quick question on this slide. Especially the first result seems important and a little bit counterintuitive to me. So I'm trying to see if I can understand it better. If you didn't have regulation, so if banks didn't face these binding capital requirements, would it still be the case that firms with higher collateral value opacity more, or is that result driven by the fact that they face these?
It's both ways. Yeah, even if they are not collateral constrained. Yeah, actually, like we have many results. Spanning various spanning many cases, but. So in the main section, the main results come from a set of simplifying assumptions, and there, actually the core is not, the capital requirements don't bind the core. So it is for them, for the core, it's coming purely from incentives, not the ability to satisfy capital requirements, but more like they prefer opacity. But yeah, like we do look into like all of those cases. This insight would come from both, but we highlight the one that comes from incentives.
But Levent, I think that's an important point that you raise. Effectively, we have the case of symmetric regulation. So in a world in which there is no collateral or the cost of collateral is exactly the same, etc., these banks always value opacity, because the worst thing that can happen with transparency is that the investor is going to run away if they see you trying to buy a lot of insurance. Which we think is realistic. That's one of the value of the private value of opacity. And as long as you make it asymmetric, you're reducing the cost of collateral in certain contracts. Now these guys start to facing this particular trade. Yeah.
Really helpful. Thanks.
So a related question, do we really, the fact that CCPs provide transparency, is that actually true in reality? I thought it was more from the regulator's perspective, that they have better sense of what's going on in the markets by getting data from CCPs, for example. So for example, do we know, how much of interest rate swaps Bank of America has with the CCP?
That's why the signal is noisy. So there can be regulatory leakage, or there can also be inference from regulators' future actions. And plus, even looking at the CCP's own activity, and there are like specializations, right? Some CCPs do blah, some CCPs do blah. And when as a market participant, and these are the big six banks, right? If you know your bank is heavily invested in some specific category, and you see some like big movement at some CCP, although anonymous, right, there is a way to get some sort of like noisy information from that overall activity about potentially what your bank could be doing. So that's how we think about it. So the CCP doesn't say this bank or that bank.
Yeah, can I add something to that? Because this is also an interesting question related to the stress test design. So one of the rationale when you read about the CCP or this, what Powell was saying is that this would also provide regulator better material for their stress test. And there is a big discussion about how transparent stress tests should be, almost for the same reasons. So once you start disclosing too much information from stress tests or putting a lot of restrictions on banks based on stress tests that the market can observe, then that may trigger some runs. So it's not an immediate transparency in terms of, okay, this is exactly the contract, but as soon as you have actions related to those positions, then that can float into the market. Yeah, thanks. That's a good question.
Right. Any other questions? Thank you so much.
Okay, thank you everyone for coming.
Thank you.
Thank you. Thank you.
Thank you, Racing you.
Bye.
Yeah. Bye.